We're very lucky today because Jonathan Woloshin just happens to be in town from New York, and he's here to speak to us. He's the co-head of fundamental research for UBS Wealth Management in New York. He's the lead real estate analyst and is responsible for covering commercial and residential real estate as well as the lodging industry. He has 30 years of industry experience as a securities analyst, having covered virtually every equity sector over the course of his career. Obviously, thanks to UBS for bringing him to Tucson. And Jonathan is going to cover some specific areas of the economy and current risks and opportunities in real estate. Ginger Knoop is the owner of Bright Future Real Estate Research. It's the most comprehensive publisher of the housing market data for Pima County. She's been involved in both commercial and residential real estate in Tucson area since moving here in 1996. She's a graduate of Michigan State University with degrees in economics and international relations, and she'll discuss the housing market. Love the housing market. Justin Linné is a multifamily broker with NAI Horizon, who currently have offices in Phoenix and Tucson. Justin has 39 years experience in commercial real estate brokerage and development. You told me to say that, Justin. He began his career as a retail broker with Coldwell Banker in Tucson and has brokered over $1 billion in transaction volume. Justin will give us an update on the multifamily activity. Dapper George Larson is a principal with Larson Baker LLC. With partner Don Baker, the company has grown to include the ownership over 2.4 million square feet of commercial real estate in southern Arizona. George has been a broker specializing in commercial real estate since 1980. He has an MBA from that place up north, the Arizona Normal College in Tempe, and is a senior emeritus instructor at the CCIM Institute. George is going to discuss the deal, what we call the deal of the quarter, and also give us some information on the retail market. Jonathan, would you lead us off?
Certainly. Thank you, Bill, and good morning, everybody. It's nice to hear I'm like a rookie compared to you, 39 years. Wonderful. When Bill gave me the topics he wanted me to talk about, he said, you have 5 minutes to speak. And he said, oh, we expanded it to 7. I said, well, it's a good thing I'm an over-caffeinated New Yorker because I talk too fast to begin with. Just one of the things he asked me to talk about was just, kind of where are we economically? And have we lost momentum in the recovery? And I think that's a fair statement. In fact, we as a firm, we have something we call our house view. We publish every month looking at every asset class around the world as well as the economy. And we recently did lower our GDP forecast for the year to about 1.5%. While that may prove a little conservative, and we certainly hope it does, I think it's a fair statement to say, there has been some slowing in the economy. But I think the important point here is there's no R word here, the R word being recession. And this is a narrative. Certainly we're hearing through a lot of our clients and amongst the market participants, we're definitely going to recession, we're definitely going to recession. That is certainly not our call here. Are there things to be worried about? I think it's a very, very fair statement. We heard from the European Central Bank this morning. They're enhancing their quantitative easing program. They cut rates yet again. So clearly, we need more impetus here, but we do not see a recession going on. I think one thing that is important is to look at the employment picture. And I think this is one of the things we'll ultimately tie into interest rates, which I will come back to. And we think there is mixed data in the employment picture, and it's one of the reasons we believe the Fed is going to be, the Federal Reserve, I apologize, too many acronyms, why the Federal Reserve is going to be a little bit more reserved in their interest rate increases. A lot of people, including us, came into the year thinking the Fed was going to move at least 4 times to the upside. And then there has certainly been some data, both domestically and globally, that we think will sort of pull those horns in a little bit. And there is a mixed bag in employment. And I think the couple of things I would highlight, and I have a very long and boring presentation with all the data in it, but the 2 things I would highlight are, number one, if you look at the difference between the unemployment rate that the Federal Reserve, that the Bureau of Labor Statistics gives us every month called U3, that's that 4.8% number that we saw. But there's a broader measure of unemployment called U6. That's unemployment and underemployment. That number's in the mid-9s. It's a truer measure of unemployment. And so I think that gives a clearer picture. The other thing is, if you look at wages, wages have been very, very stagnant. We've had very, very little wage growth with very few exceptions here. And so we think, while we're creating jobs, and that is a good thing, the bottom line is wage growth has still been very, very, very stagnant. And so that's something that we certainly does hope change. On the positive side of the equation, unless you're in North Dakota, Oklahoma, or Houston, don't underestimate the impact of the decline in energy prices and how this could impact the economy. We consume about 145 billion gallons of gasoline a year in this country. So think, in fact, I drove by when I was coming in from the airport last night. I saw, I think, $1.19 for regular. Now, I'm from New York. That was like a godsend when I saw that. But don't underestimate how important that is. Every 1 penny drop, $1.45 billion in disposable income. And has it taken longer to filter through the economy than some people thought? I think it's a fair statement. But nonetheless, we think this will be a positive. So the impact of interest rates and ultimately how we think about it in terms of real estate, we think we're in what's called a lower for longer environment. And what does that mean? Now, understand that everybody thinks, those of us on Wall Street, we can see forever into the future. I would tell you, anybody who comes to you with a forecast that goes beyond 18 or 24 months, I would be very, very suspect with. But certainly our view is looking over the transom of the next 18 to 24 months. If the 10-year Treasury is about 1.9% this morning, we see that bouncing around somewhere between, 185 and 225 over the next certainly 6 to 12 months. So, and over the next 24 months, could it gravitate up into the mid-twos? Maybe, but we don't think we're going to be in a situation. This is not 1994 revisited. So what are the implications for real estate, especially commercial real estate? We think this will be generally constructive for real estate, but I do have one caveat here, and it is a soapbox issue for me. Don't get lulled into a false sense of complacency. Commercial real estate's a long-duration asset. So I may be talking about 18 to 24 months, but if you're looking at a deal over the next 10 years, I would urge you to just kind of build in different interest rate expectations and at least stress test your deal. So how does that translate into cap rates, which is obviously going to be one of the big considerations. And if we look across the different property types within cap rates, you've seen obviously since the beginning of the decade in 2000 a tremendous compression in cap rates across all asset classes. We had a little blip there in that unfortunate period of 2008 to 2009, but in general we've seen a huge decline in cap rates, particularly in multifamily, which is my favorite asset class, so I look forward to your comments, Justin, CBD office, central business district, and Class A malls. So our view is it's going to be much harder to see, and I'm speaking generally now, a lot more cap rate compression. We've seen a lot of capital come in the market, so we think for values to increase significantly from here, you're going to have to get it through net operating income growth because we had such a compression in cap rates. So while we're not bearish by any stretch of the imagination, we think generally, and I'll talk about the asset classes we generally think fundamentals are pretty good. Nonetheless, we have seen a lot of movement in cap rates. So now it's going to be your basic blocking and tackling that we think is going to be really important here. In terms of our, fundamentals, we think fundamentals within multifamily remain very good. Industrial, so I was very pleased to hear all the industrial comments this morning. We are very, very bullish on industrial. So we think industrial is in good shape. Self-storage is another one. And retail, and Bill asked me to talk a little bit more about retail. There are parts of retail we like, parts we're cautious on, but generally that's where we're most favorably disposed. We're a little cautious on office, particularly suburban office, and I think it's really a function of, I'm speaking nationally now, we've overbuilt office. Largely, number one. Number two, we have what we're seeing in a lot of large cities, this reurbanization trend. Our friends, the millennials, are driving a lot of people and a lot of businesses back to the urban core. So we think suburban office is generally going to be challenged. But aside from that, generally we think the fundamentals in commercial real estate are really good. What sectors have the highest investment activity? 3 of the last 4 years, multifamily has been the star of the show, and it's a terrific asset class. And I'll be intrigued to hear the housing comments as well, because I do work in both the housing market and commercial real estate market. So there's a lot of crossover work in what I do. And while I think we will still have more demand for housing, I think the demographic makeup of the country is still very, very well defined for more rental. So we'll see. One of the things Bill asked me to talk about was the online impact of retail. And not all retail is created equal. And I had a friend of mine who runs a hedge fund who called me in 2008 and said, the world's coming to an end. He's not always right, but never in doubt. The world's coming to an end. and I want to short retail. And this is a true story. And he said, I'm going to short Tanger Factory Outlets. And I said, that's the last company I would short. And he said, why? Because I said, their underlying business is a great business. And so this is what people misunderstand. They hear retail, they hear online, brick and mortar retail is dead. No, not true. Some of brick and mortar retail is already dead. You know, Blockbuster Video, you don't see music stores anymore, bookstores are going the way of the dodo bird. I absolutely accept it. Class B and C malls, those tertiary and secondary malls, I think are going to be in a lot of trouble. But if you look within what we call the Class A mall, the Fortress Mall, like if you go up to Scottsdale, Fashion Square Mall, it's a very, very good mall. The mall, in our view, the Class A mall is going to be here for quite a long period of time. The strip center, think about what's in a strip center. You know, you have a drug or a grocery store on one end. You got a pizza place, a nail salon, a dry cleaner, maybe, you know, maybe a doctor's office. I always say this, if anybody in the world will figure out how to get their nails done online, it will be my wife. That has not happened yet. So the bottom line is this is not going to be, in our view, a major problem. And as I said, premium outlets. Premium outlets is a great business. It's a destinational business. It's a tourist-driven business. So I urge you, when you think about retail, there is a lot you have to really segment. Big box retail has generally been more challenged. You have winners and losers. Concepts come, concepts go. But the really good operators, and I just spent some time with the Simon Property folks, and they took us through how they're embracing technology. And if you remember from The Godfather, that said, keep your friends close, your enemies closer. Well, that's exactly what they're doing. And they're saying, we're working with our technology partners. We're not running away from them. We're working with our retailers. So I urge you to really stratify when you think about retail. Just a couple of other points that I think are important. Access to capital. Am I running out of time?
We'll give you 30 seconds.
Oh, my God. Access to capital has been great. Access to capital has been great with one exception, the CMBS market, commercial mortgage-backed security. We're starting to see some bifurcation in that market. The sub-investment grade is getting a little sketchy, so be careful there. And regulatory, I have to say one thing on regulatory. One of the things that has been talked about, should we ever get a political discourse on tax reform, which is certainly possible once we get out of the silly season of the investment cycle. One of the things that has been talked about in Washington is the potential to eliminate 1031 exchanges. For those of you who know what 1031s are, you know how bad that would be. So I tell you this because it's been discussed. I tell you this because it is on the table as a potential item. Please call your representative and tell them how bad that would be. All right, I'm done. Thank you very much.
Jonathan, we're going to get you come back as a keynote when you have more time. So seriously.
But then you get 120K slide deck.
That's Ginger, you're up.
Thank you. I appreciate Jonathan's comments about the slowing economy nationally. From our local housing market perspective, we're still waiting to gain momentum. And so when we talk about the national economy starting to lose momentum, it elicits some big concerns locally in terms of our housing growth and what's happening. We had a decent year, some improvements last year. There were about an improvement of about 10% in total sales volume last year. A little more than 17,000 homes sold in Tucson. That was about 1,600 more homes selling last year than the previous year, and the improvement in the new home market was 9%, so nearly the same, but it was only 166 homes. So more than the previous year. So we're losing ground. And market share is still a challenge here for the new home builder. That all goes back to jobs and the economy. And I sure hope that selectors conference is not in June. It's fantastic they're coming. I hope it's not in June. So we are still concerned about the level of distress in the market as a whole. There's still too much distress. Phoenix has brought their level of distress down to about 3%, and 3% is where we were at prior to the world changing in 2005, so that's where we need to be. We're at 14%, and my measure of distress encompasses a little more than just the REOs, and it's not as REOs and shorts, so the numbers you see out of TAR will be a little lower than mine. We're at 14%, we need to come down to 3%. Until that happens, it's very difficult for the new home market to compete. So new homes, the prices of new homes, the gap between new homes and median and resale homes continues to persist at about 50%. We're asking people to pay 50 to 60% more for new homes right now. And so our market share lies at about 11%. So those two things go hand in hand. And it's all connected back to job growth and what we see. In terms of lot inventories, we saw a little dwindling late last year. As in the cycle, we saw a thinning of lot inventories late in the year. Lot delivery in the first couple months of this year has been relatively strong, with nearly 1,000 lots coming to market. Now that's concentrated in, Maracay at Vistoso's 300 lots, and Saguaro Bloom released 200 lots of their newest acquisition after investing $42 million last year to purchase the balance of that community. So they've opened up their next series, phase 2. Also saw Academy Village open back up under Miramonte's moniker. Now that was purchased last year by a local investor, and now is they're building again out there. So some active adult activity as well as single family activity in those numbers. In the next couple months, I expect about another 500 lots to be released in the coming 3 to 4 months, next quarter. That lot delivery will be much more dispersed among smaller local builders, some in the interior, and the only large lot delivery we expect in the coming 2 quarters really would be at La Estancia, where Meritage will open up at the end of next month as the first builder in there, and that's our first master plan to open up and be built in many, many years. So it will be interesting to see how that develops. I think that La Estancia, along with Rancho Saurita, those two kind of anchor the industrial corridor that we have. So the development in those two communities are very important to the future and providing housing for the people that work in the industrial sector. I'm happy to see interest rates remaining in check. That's super important because the home builders are having a terrible time competing in the entry-level market as it is. And those interest rate increases further damage our ability to compete in that entry-level under $250,000 market. So anything that we can do to support sales in that area is going to be important to increasing market share, because over 70% of our homes are sold at a cost of under $250,000. So that's where we're at in the housing market.
Well, it looks like we're going to have rental increases. Start with a little story. Probably in 1988, 89, I was working on a deal with Bob Davis, Bill DeVito, with a fairly large, sophisticated developer out of Los Angeles. And we worked out a pro forma, and the computers were working, and we punched some numbers in with some rent growth. We sent it to him, and I said, well, there's rent growth. And he says, well, you haven't had rent growth since you guys gave that state back to the Indians. And so I said, well, that's not true, and I went on. But we are having rent growth in the apartment market, and the reason being is we've had job increases, 8,900 new jobs that were created in 2015, with 5,600 jobs created in the fourth quarter alone. Our vacancy rate is down to 7.82, and we had a rental increase of 3%, and that vacancy is the lowest since 2007. We've had a 45% increase in sales activities with a cap rate of about average 6.7%. With jobs comes better NOIs, more occupancies, less vacancies, and our yearly sales have improved for the last 5 years. So we're becoming healthy again. I think in 2009-10 we had negative population growth, negative job growth, and we are finally seeing that. An example, our population in 2002 to 2006 was 20,000 new individuals. In 2012, we had 5,000 new individuals come into Tucson. 2015 looks like 10,000 increase in population. We have had absorptions of about, 800,000 units per year, building about 1,000. So it's kind of an equilibrium in our marketplace. Permitting for 2015 was 1,000 units. Regarding major sales, there was a large portfolio sale. Ross McAllister, who is here, bought 1,575 units for $66,700,000. Is that right, Ross? Yeah. Okay, close. And that was a real low cap rate. I won't give it, but he says it'll increase over the next year because everything's value add. Center Point project over at near Ina Thornedale sold for $105,000 a unit, probably around a 6.1 cap rate. Avia Preserve, which is a Carver single-story product, sold for a 6.15 cap at $147,000 a unit. Just as an example, we're working on a ground-up deal in Irvine, and that 147 is a unit is probably the highest improved sale. In land alone, in an Irvine deal, it's a podium, 5 stories. We're looking at a land value of $95,000 a unit. And on top of that, there's impact fees that the city of Irvine and state of California put on them of $45,000 a unit. So their land value on that deal is equivalent to our highest improved value. So there's a difference in markets. Irvine, LA, major markets are below sometimes 3 cap rates. We're about an average of, again, 6.7, but our newer products below 6. We're about 100 basis points above Phoenix, and we've had a lot more activity. There'll be more activity as newer projects that become stabilized. Out-of-state investors come in and look at it. We do not have any really institutional investors in Tucson. Most of it's private equity, but no REITs, no insurance companies looking at our market at this time. Thank you.
Morning, everybody. 2 years ago, the Pima County Real Estate Research Council asked me to talk about a transaction that we did in 2014, buying the MDA building. And I said at the time we had no idea how this investment would turn out, but I'd be glad to come back in a couple of years and tell you the rest of the story. So I'm here to do that. Let's look at this investment opportunity when we were looking at it in 2014. We bought a mostly empty 83,000 square foot office building. Purchase price was about $100 a square foot. We had the usual naive enthusiasm. We thought this was going to be a good deal. We had a great bank loan from our friends, mostly done on faith. Alliance Bank provided the financing. That's where we left you, dear audience. Before we went through the disillusionment, panic, search for the guilty, punishment of the innocent, and the final stage, success or bankruptcy. We knew that things would not go exactly like we had planned them, but I thought it might put that pro forma up, put the pro forma up that we started with that you all saw, those of you who were here. So we thought we'd have a full service rent of about $28 a square foot. We'd have a 10% vacancy. By the time we took $9 operating expenses, we'd have about $1,345,000 in net income. A 7.5 cap rate would give us a $17 million value if we were successful in leasing it up to a number of small tenants. Potential developers' profit, well, maybe $4 or $5 million. That's what we hoped. Here's what happened. Buzz Isaacson, Dave Volk, Dean Kahlo all told me, hey, it's not going to be as easy as you think. The second you start breaking up a building that was not designed to be broken up, you have lots of inefficiency costs. You also have the new trend where people want open offices where they can have ping pong tables and hammocks. They were right. We first presented the offices to Morgan Stanley. They declined, and what really hurt us is they went down the road and leased from Desco Southwest at higher rent. We lost Mr. Car Wash. They left their Foothills office and went to a slum downtown that they rehabbed. We presented the offices to Wells Fargo, to Merrill Lynch, to UBS, to Pima Medical Institute, to Sonoran Laboratories, and to the Safari Club. Everyone thought our office building was beautiful. No one wanted to move in. We're about to offer the entire space to the mattress firm. They would have taken it. Now it's the late summer of 2014. Mark Irvin introduced us to SunQuest Information System. SunQuest loved the offices. SunQuest needed all the space. SunQuest was well qualified. We loved dealing with Mark Irvin, even though the long-distance phone calls to remote fishing camps in New Zealand were expensive. SunQuest, 100% occupancy for our office building. This time, it's different. One minor problem, SunQuest lease doesn't expire until December 2016. Remember, we're in 2014. We need to be creative. Well, Larson Baker is nothing if not creative. In our dreams, SunQuest moves in early 2015, pays us CAM expenses until their rent expires in their other building, and then pays us net rent of, say, $22.50 a square foot. We thought an 11-year lease sounded like a good idea because, of course, the first year we weren't going to get any rent. So we sent that letter of intent to SunQuest. Their national real estate broker first wanted a commission agreement. We comply. We offered a commission of $500,000 to the leasing brokers. We hear nothing more about commissions, but also we hear nothing more from SunQuest for the next 5 months. Now we're back to a real pickle. We're paralyzed. We can't go leasing to a 5 or 10 or 20,000 foot tenant when we think SunQuest is going to come back any time now and respond to our letter of intent. So we don't know what the heck to do. Finally, a response from SunQuest. But SunQuest broker has determined that the office market in Tucson sucks. Eric Raymer thinks the landlord should be happy with a $14 a square foot net rent deal. After all, lots of office deals are being done all over town at $18 a square foot full service. And as you know, an $18 full service lease is equivalent to about an $8 or $9 net rent. Oh, and they need a lot of TI allowance. All right, it's true that the office market sucked. So, of course, we have to blame someone else. We believe the office submarket is different. It's not the east side or the central office market. We had spirited discussions with Eric and Mark. We pointed out the Morgan Stanley build-a-suit lease comp. That was over $24 a foot net. They said that's comparing apples to oranges. We showed Eric the comp for the 8-year-old long realty office on Sunrise Drive at $30 a foot gross. Eric said that's comparing oranges and pears. We informed him that he had all the attributes of a dog except loyalty. He didn't care. So we decided to hire an MAI appraiser to give SunQuest an appraiser's opinion of current market lease rates for the Foothills submarket. About $5,000 later, we had our answer, and it was higher than what they were offering. SunQuest agreed the rent should be higher. Net rents were appropriate. SunQuest was back interested. In early 2015, we received a revised letter of intent from SunQuest with a net rent and rent escalators where we wanted them. SunQuest would move in the spring of 2016. Are we done yet? No. The lease document was difficult. Architects were brought in. We had 17 different drafts. Then the other shoe falls. By late summer 2015, we're making progress. We got an 11-year lease. We got 2% plus annual bumps. The lease will be corporately guaranteed by SunQuest parent corporation, Roper Technologies, a $3.2 billion corporation. What could go wrong at this late stage? Here's what. After having the appropriate language in every letter of intent and 15 draft leases, the president of Roper Technology now says that Roper Technology will not guarantee the lease. Oh, and Roper will also not allow any of its subsidiaries to have any kind of a longer lease than 7 years. Corporate policy. Oh, and Eric Raymer from Atlanta tells us he finally got around to reading the commission agreement. He tells us $500,000 is not nearly enough. He said, my mistake was that I calculated the commissions based on the net rent. He said, when in fact most office leases are full service, so of course he wants his 5% commission based on the equivalent gross lease consideration, not the net rent. He apologizes for bringing this detail up so late in the negotiations. All right, our partners in the MDA building are distraught. How could we be forced into conceding these points after the rental rate was decided? I haven't seen Don so worked up since I spilled mustard on his suede Gucci loafers at lunch one time. George Stamos and Melissa were inconsolable. They thought we should give in. We can't miss not getting this tenant after a year and a half of negotiation. They were going through the Keebler-Ross stages of grief, you know that? Denial, righteous anger, existential despair, acceptance of medical marijuana, Sonoran dog overeating. Andy said to me, George, don't cave in. He said, George, I don't know the meaning of capitulation. I told him he also did not know the meaning of aphorism or mendacity or a bunch of other big words. It was take it or leave it, according to Eric Raymer. But think about this. A 7-year lease is worth significantly less than an 11-year lease. The lack of a Fortune 500 guarantor means less tenant credit, which means less asset value. I'll stop here while you give me advice. What do you think we should do? How many of you think we should take what they offered, which was, we were told, was non-negotiable because it came from the president of Roper? How many say take it? Take it. You're done. You got 100%. How many say don't take it? How many say when's the break? All right, here we go. The grand compromise. Our final strategy was to be prepared to walk away from the deal, but to try not to. With shaky resolve, Don and I agreed we would only trade concessions, we'd not give them up. Here's what we did. We kept the lease term at 11 years, but added an early termination option. In return for the SunQuest early termination option, SunQuest agreed to defer $400,000 in the TI allowance. In addition, if SunQuest exercises its early termination option at the end of year 7, it must pay the landlord, this is a contract term, an awful lot of money. We agreed to pay the higher commission to the leasing agents. That should keep Mark in canali suits and New Zealand trout streams. We got the deal done, and we all sang Kumbaya in November of 2015. The managers and principals of SunQuest Information System, despite me teasing them, are the nicest people you could meet. They'll be great tenants. And the final numbers look something like this. Let's see. If we're looking at that and we took a little bit of a vacancy factor, which appraisers will do, we apply a 6 cap rate because of the national credit, we end up with a $23 million potential value. And we spent a lot of money to get there, but we still think we'll end up with a pretty good profit. We did okay with this investment. But you know, all of us at Larson Baker would trade it all, would trade all the success to have another chance to do a deal with Don and go through this crazy stuff again. So we miss our partner. We know he misses the action, but we did good on this one. Thanks.